In this video, we're going to be introducing Dow Theory, and some of the objectives discussed within the video include the basic tenets of Dow Theory, using Dow Theory to identify trends and applying principles of Dow Theory to modern markets. It seems logical that higher volume would confirm trends and that industrial growth should be supported by strength in transport. So the key word for this video is trend. It's all about identifying trends, identifying the end of trends, and identifying how strong a trend really is. So to begin with, a bit of background about the man who came up with this idea, or these set of ideas. And his name is Charles Dow. He co-founded the Dow Jones Company, which is where he invented the Dow Jones Industrial Average, and this still exists today as one of the widely, or rather most widely followed barometers in US stock markets. He invented another index too, which he called himself the Dow Jones Railroad Index, and that also still exists, but it's now known as the Dow Jones Transportation Average, and it's not nearly as well known as the Industrial Average. He pioneered studies in trend-following technical analysis, and whilst the idea of trends in markets seems quite obvious of a concept these days, that wasn't the case back in the late 1800s. And he also created something that might be familiar to a lot of people watching today by the name of the Wall Street Journal. This still exists today as one of the largest outlets of fundamental news in the world. But it's interesting that the publication actually began as a technical newsletter, which was edited by Charles Dow himself. So, it's important to understand that Dow Theory is all about trends. The idea is that if you can identify the formation of a new trend, you can thus trade it profitably. Dow Theory is not about trying to be too clever. It doesn't try to predict reversals, it waits until they are confirmed. And as such, it can be considered a reactive rather than a proactive methodology. So the there are six basic tenets of Dow Theory. We will go through each one in a bit of detail, but just to list them first. The first being, the averages discount everything. The averages refers to two stock indexes invented by Dow, the Dow Industrials and the Dow Transports, of which many may be familiar with in the current day. And there are three degrees of trend being the second basic tenet. The third, being primary trends, have three phases. The fourth, which we shall get up now, being the averages must confirm one another. The fifth being volume must confirm this trend. And the final basic tenet looks at a trend existing until there is evidence to the contrary. So, the averages discount everything. That is that the first tenet is an underlying assumption that the Dow Theory rests on. The averages discount everything, so specifically everything but acts of God, so like natural disasters and earthquakes. This means that all known information gets factored into the price of averages, since every single market participant who has information will buy or sell based on that information. Therefore, price is a perfect reflection of the opinions of every investor. This gives rise to the biggest misconception of Dow Theory. Now, most people believe that this tenet is the equivalent of the efficient market hypothesis, otherwise known as the EMH. Now, they think that the Dow Theory rests on the assumption of EMH. It's really important to clarify that that is not true. Dow Theory does not rely on EMH at all. EMH assumes that price is a perfect reflection of all information at all times. But there are two assumptions in EMH that are not true and do not align with Dow's view of the market discounting. So, the first thing of EMH is that it assumes all information gets discounted instantaneously. Well, that is not true. It takes time for investors to understand, digest, and respond to new information. There are millions of market participants and they all respond to new information at very different paces and in different ways dependent on their investment philosophy and time horizon of interest. So the second problem with EMH is that it presumes market participants discount all information rationally, and that is not true either. During the discounting process, markets are actually discounting opinions of information rather than the information itself. So the market discounts all personal beliefs, biases, psychology, herd psychology, and risk tolerance. All of these factors are based on emotion, which is not rational. Remember, emotion is not rational. So if you hear that Dow theory rests on EMH, you'll know that that's not true. Dow did not believe in EMH. He understood that it took time for markets to discount information, and when they did, it would not so necessarily do so rationally. It's better to think of the markets as a perpetual process of adjusting to new information. So for the second tenet, it is that there are 3 degrees of trend. Now, at the highest degree, we have primary trends, or tides as Dow called them. But each primary trend includes a number of secondary trends, or waves, and each secondary trend is made up of minor trends, or ripples. So we'll pull up a chart right now, and in the chart here we can see that the whole move from the low to the high, the dark blue line shows that from the low to the high, is one primary uptrend, but that could be divided into smaller secondary trends shown by the red lines. Those are the smaller secondary trends, and it could be further subdivided into minor trends, which are shown by the purple lines. The purple lines show the minor trends. So Dow thought that minor trends should be ignored as they're meaningless market noise. That was his opinion. They shouldn't be traded, he thought. And for the same reason, he ignored all intraday price data and only plotted closing prices. There was one exception, though, where it made sense to trade minor trends, and that is the formation of what Dow called lines. You might know them as horizontal trend channels. Dow thought it made sense to buy at the bottom of a channel and sell at the top even in minor trends because it was an easy way to make profit at the time. We've got a little graphic here that shows that same example. You see a price moving, you got a little channel forming, and now you can see that the price is sticking to that channel, and that is that minor trend, or ripples, as Dow would put it himself. You can see here, there we go, and then you break out of that range. So the third tenet says that each primary trend is made up of 3 phases, and for a primary uptrend, they have to be the accumulation phase, and then the trend phase and the distribution phase, which comes after. So a primary uptrend could look like this diagram here. In the accumulation phase, the market is, or rather the informed market participants are buying up shares in preparation for a rise in price. So usually the sentiment among uninformed participants and news headlines around here are negative and bearish. This is where one accumulates. Uninformed participants are usually selling here, but then in the trend phase, the market starts rising, and that's also called the public participation phase, when the herd get involved and everybody starts buying. Not only smart money, but also dumb money in this case. Now that is because this is where, as price rises higher and higher, members of the public start to get involved. So people who were initially bearish and selling in the accumulation phase are seeing the price rising and start rush themselves to buy into these things, and you can see that the price starts to move up. But the trend phase is normally where the largest part of the move happens. We must remember that. And finally, there is a distribution phase. At this point, uninformed market participants are usually very bullish, having made money in the end of the trend phase and expecting price to keep rising. However, informed market participants are actually starting to offload positions and prepare for a downturn, however you'd like to put it, which eventually materializes. So you can see with the distribution phase, let's just point it out there, and then you can see the sellers start to come out, the price starts to fall down. For a primary downtrend, you normally start with a distribution phase, and then there is a larger trend phase which takes prices lower, and then finally a new accumulation phase. Note that the accumulation and distribution phases do not have to be sideways consolidations, as shown in the diagram that we have here. You can and often do see price rising in these phases, but the major part of the move will still usually be in the trend phase. So here's an example of the 3 phases of a primary trend in Apple shares. We have an accumulation phase at the bottom around here, and then we have a large trend phase which has a lot of strong, powerful bars. One example here, one example there, another example here, another example there. Those strong, powerful bars are pushing the price higher, and finally a distribution phase comes after, where the informed market participants sell out prior to a decline in price, where we can see here, post that distribution phase, you see a decline. That's usually when the smart money gets out, if you've ever heard of that term. But the averages must confirm one another, being the fourth. So remember, the averages that we're talking about in this case include the Dow Jones Industrial Average and the Dow Jones Transportation Average. This tenet means that a buy or sell signal in one of the indexes must be confirmed by a signal in the other index. If there is only a breakout in one of the averages, it's not considered a buy or a sell signal until the breakout occurs in the other average too. So the logic behind this is quite intuitive. If the industrial average is rising and breaks to new highs, well, that booming industrial sector should naturally be accompanied by strength in the transportation sector. Think of it. Since all of those goods have been churned out by industrial factories, they're probably going to need transporting somewhere. So they should be intertwined. If one index broke out and the other did not, there is a good chance that the breakout was based on speculation rather than any underlying economic strength. And as such, it is probably a very weak trend that could end abruptly, reverse, and it would all be over with. However, this tenet is generally considered less relevant in modern times because of the contribution of services and non-physical goods to economic output, otherwise known as GDP, or whatever creates value in an economy. Non-physical goods do not require transportation, so the averages are perhaps not as connected as they once used to be. Here's how this tenet works in reality, the fourth tenet. We've got the Dow Industrials along the top and the Dow Transports along the bottom, and we have both weekly charts. The first one is a weekly chart and the second one is a weekly chart also, just for reference. And you can see that both charts are making the same general shape, but the industrials show a breakout above prior resistance in the blue circle. Let's show here. That's a breakout above that prior resistance here. We've got that breakout. The first of which was a little fake breakout. But if you were looking at the industrials chart in isolation, which is once again the one above, you could be feeling quite bullish at that breakout. There's been a breakout and it looks like the beginning of a new uptrend. However, if you look at the transports, you can see that there was not a breakout there. It failed to overcome that prior resistance level, which was the red line. You can see here, there was not a breakout. Failed to break above the resistance around here previously, and once again failed thereabouts. This is your warning sign that the breakout in the industrials isn't actually because of economic strength, but more because of speculation, and the uptrend likely wouldn't last in this case. So soon after, both markets actually went to crash, and that buy signal was never confirmed by the transports average. You see here, we never saw a confirmation of that breakout, and they both ended up dumping, which is recent data here too. Here's another application of this principle, but at this time we're using different markets. So instead of using the Dow Jones Industrials and Transports, we're comparing the S&P 500 and the Russell 2000 indices. So 100 years ago, the Dow Jones averages were the main broad indexes available to compare, but these days there are a lot more options. So you don't need to feel limited to just using Dow's original averages. Instead, you can apply the same principle to other correlated markets like large cap and smaller cap indexes, or gold and silver, for example. You can see here that looking at the S&P in blue, we've seen a little breach of resistance after a little fake out again. You can see there. It came down to retest as resistance, as support, and reversed, and is now pointing upwards. So it looks like it's about to kick off a new uptrend. You can see it failed the first time, second time seemed to have worked. Now, if we look at the Russell in red, shown here, then you can see that we haven't had a breakout, and it's still quite a substantial distance from breaking onto highs. And we must ask ourselves here, what is this formation here telling us? Well, if the largest cap S&P 500 stocks were hitting new all-time highs because of the booming economic conditions, then why aren't these smaller cap Russell stocks benefiting too? The Russell isn't confirming the trend in this case, and that should be considered a warning sign. Well, let's see what happened next. The S&P 500 continued rallying for a short while, but the Russell never confirmed the uptrend because it never broke to new highs. The rally in the S&P following the breakout was short-lived, and both markets crashed. Well, both in this example and the previous one with the Dow Industrials and Transports were taken from the exact same time. It's interesting that whilst both the Dow and the S&P 500 were making new highs, neither was confirmed by Transport or the Russell 2000. The fifth tenet is that volume should confirm the trend. If you're not sure what volume is, it is simply the number of shares or contracts that are traded over a period of time. So while price data shows the price level that the market is trading at, the volume shows how much of it is being traded. Now, in order for us to see volume confirm the trend, it should expand or increase, if you're not familiar with that term, whilst the price is moving in the direction of the primary trend. And it should contract, meaning fall, during any secondary reactions where price is moving against the direction of the prevailing trend. And that's because declining volume is a sign of weakness in a move. Weakness in a secondary pullback or in secondary pullbacks is showing that investors are still more interested in the main primary trend direction. So here's an example of volume confirmation in a trend in shares of Disney. So there is one main uptrend here that is made up of 7 swings, and we'll put that there. We put vertical dashed lines to divide the trend into 7 zones so that we can compare price and volume direction for each swing. So let's look at the first swing here. The price seems to be moving in an upwardly direction whilst volume is expanding, and that's a bullish sign. Well, the increasing volume is showing commitment of capital to the move, and that confirms the uptrend. Now, in zone 2, we'll go here. The price is moving in a downwardly direction for a secondary reaction. Volume is contracting here, and that's showing that investors aren't interested in the down move, and they're more interested in the larger uptrend still. So this is also confirming the uptrend. It's a healthy retrace. You don't normally look to just see things go consistently in a straight line upwards. It's never, rarely to say, at the very minimum, that is rarely the case that things go up or down in a straight line. Now let's move on to the third zone. We can see rising price. Here we can see expanding volume as well. And in zone 4, we have another secondary reaction accompanied by the contracting volume. So we can see here, price falls, but the trend is still maintained. If you imagine a rough trend line here, price falls, volume falls, but trend is still maintained. The same pattern repeats in zones 5, 6, and 7, as we've just discussed. So volume confirmed the trend at every step of the way. And after zone 7, while the market starts moving sideways, whilst volume is flat, and the trend here is no longer being confirmed as market conditions have changed. If you want to know more about volume, check out our video on volume and open interest. It will either be in the description of this video or it will be in its respective section on our YouTube page. We go through this example here in a little bit more detail then of what exactly lower price, lower volume, higher price, higher volume, or maybe even if you had lower price in terms of where you started at, you ended up lower, and your volume maybe was rising. What those signs mean, we have a separate video that looks at that, and that will either be in the description or you can just search it openly on our website or YouTube, whatever you desire. So for the final tenet, it is that a trend exists until there is evidence to the contrary. So that means a trend is presumed to be intact until there is evidence of its reversal. Dow theory doesn't try to predict that a trend may have ended. It always assumes a trend is still in effect until the reversal signal is generated, or a reversal signal, whatever really. We'll go through what those reversal signals or signs are in a moment. So it's a case of reacting to what the market does, rather than preempting and making decisions proactively. This tenet is sometimes, however, criticized for making Dow theory slow to react in fast-moving markets where a trader might want or might risk losing a significant chunk of their profits waiting for the reversal signal to be confirmed. There are 3 reversal formations we look for in Dow theory. So, along the top, there are 3 formations. The 3 formations as they occur at the end of an uptrend when it reverses into a downtrend. You can see here, things are looking great, then they look bad. That's reversing from an uptrend into a downtrend as a reversal formation. And along the top, we have the 3 that are valid in that situation. Now, along the bottom, we have the same 3 patterns as above, but inverted, as you can probably notice, which is what happens when a downtrend reverses into an uptrend. So I'm going to quickly give an example to work through these and explain what they are, and then we can move on. So a failure swing in the top left. That happens when an upswing fails to reach the previous high. So in other words, when we get a lower high, which signals the end of an uptrend. The formation here is confirmed when price falls below the support from a prior low. A failure swing at the end of a downtrend is when a downswing fails to reach the prior low. So for example, we get a higher low. It is the exact opposite of what was above. The reversal here in this case would be confirmed when the price breaks above that prior resistance. Now for a double top, it is like a failure swing, but the upswing this time is able to match the prior high but not exceed it. So we have 2 highs at the same price making or marking a strong point of resistance. However, the reversal is not confirmed until price breaks below that prior support. A double bottom, which is directly below the double top on the diagram we have. That double bottom is when price makes an equal low with the most recent trough. The reversal is confirmed in this case when price breaks above prior resistance. Now for a non-failure swing, just to provide reference, we're here at a non-failure swing. That occurs when price doesn't fail to make a new high. So it looks like an ordinary continuation of the uptrend, but then the price falls all the way down below the prior support. Basically, we go straight from a higher high to a lower low without a lower high in between. So there are 2 potential points where you can consider the reversal confirmed here. If you want a more aggressive entry, you could use the point where price falls below the final low of the uptrend, so the higher support. But the final, more reliable confirmation comes when price makes a new lower high and then falls below the first low after the highest peak, which is referred to as the lowest support. And the reverse applies for a non-failure swing at the end of a downtrend. Price, in this case, would successfully go from a lower, well, goes lower rather, to make a new low, but then rises all the way to make an immediate higher high. Again, there are 2 points which can be considered confirmation of the reversal. So for an aggressive approach, you could consider when price breaks above the last high of the downtrend, so the higher resistance, or the final confirmation is when that higher high has formed and then has been taken out in a later swing, penetrating the higher resistance. So let's have a look here at the Dow Jones Industrial Average Index. This is once again a weekly chart shown by this bit here from a wonderful TradingView chart. But the reason why we put this visual up is that we want to tell a little bit of a story summarizing the things we've learned. So in the beginning of this graph, we're in an uptrend with a series of higher highs. Let's get that up there. Higher highs and higher lows. That is until we get the first lower high, which is seen just after these series of high highs and higher lows. We can see that first lower high, which breaks the cycle out of higher highs and lows. Now, that sets the market up for a potential failure swing. So the reversal here is confirmed here when the market breaks below that prior support, meaning we have a lower high and a lower low, and the downtrend is confirmed. And then we have a series of lower highs and lower lows through the entire downtrend until we get a higher high, which comes straight after. Let's get our higher high. There we go. We've also got a higher low there. That's where our reversal confirms, and then the market changes in another direction. That sets up for that potential failure swing, which is confirmed when the market breaks above this particular resistance. And then the market is back into an uptrend with more higher highs and higher lows following. Now, to conclude, we've covered in this video an introduction to Dow theory. Dow and his students popularized the idea of following trends over 100 years ago, and his principles hold true today. Many modern technical trading systems are rooted in Dow theory. Dow theory is really, to be honest, the foundation upon which a lot of modern ideas, technical analysis, were built upon. Now, the best way to really learn to understand how this analysis works is to go and look at lots of charts, get that practicality, look out for trends, reversal patterns, volume, and cross-market confirmation most importantly. You'll find it gets easier and easier to identify strength and weakness in trends with experience as you study more charts. And there are so many different things you can compare with one another. We just mentioned gold and silver earlier to try and help yourself to understand cross-market confirmations or cross-asset correlations. If you want to start looking at other areas of technical analysis which may complement Dow theory, maybe try looking into some momentum indicators like the RSI and the MACD. You can maybe start by watching some of our videos on them available on YouTube and on our site.